Hello, I'm Gill Fielding, and this is what's caught my eye in the media this week. Now, I'm a fan of tracker funds, and what that means is it's an investment fund where an investment manager or a cook, as I like to call it, creates a share soup. And what they do is they buy one of every single share in a particular tracker fund and then stir it up, and you can buy a little bit. Now, these funds track a major index like the FTSE or the Dow Jones, for example. And what it means is that as an investor, you can get the returns that the overall stock market gets because you're tracking the stock market without all the hassle and the worry and the research that you might have to do. And these are becoming more popular, tracker funds in the UK, and apparently now 18% of all funds are under management are in a tracker fund, but that's quite small in comparison to the US, where nearly half, 45% of all funds under management are in a tracker fund. And that makes sense because it's very difficult to beat the market. So if you can very easily track the market or get the same return as the market overall, then you're generally quids in because the market generally does go up 8, 9, 10% over time, as long as you reinvest the dividends that you earn. And the greatest thing I think about tracker funds is that they're so cheap because there's a cook or a fund manager looking after the saucepan, looking after the share pot. It only costs something like 0.01 in some cases, 0.01% to manage these funds. Now, if you compare that to if you get a broker to buy stocks and shares for you, that will cost you 1, 2, 3, 4, maybe even 5%, depending on the input that the broker is giving. And it's very, very difficult to outperform the market on a regular basis. So my personal view is that you're much better off paying 0.01% to manage your funds and putting them in a tracker fund compared to getting a broker to charge you a lot more for doing something that might not be as good. Sometimes it might be, but sometimes it won't. And it seems like tracker funds are very popular. And as I say, we're increasing the amount of funds under management in tracker funds, but we've got some way to go to the US. So let's keep that momentum going. It seems like we all require certainty, and we're all fed up of being uncertain and feeling vulnerable during the pandemic. And it's the same for businesses just as it is for human individuals. And I noticed that some banks and finance providers are now trying to create some certainty for themselves by encouraging customers to stay with them, and therefore they give them better returns. So, for example, the average savings rate has gone up from 0.84% in June to 1.41% in August. So what banks are doing is trying to encourage people to stay with them and to leave their money with them. And HSBC, for example, are now offering discounts on their mortgage rates to loyal customers. So their normal 2-year fixed rate would be 1.39, but it's only 1.29 for existing customers. So they're actually creating a loyalty bonus, if you like, for people to stay with them and to leave their mortgages with them. And that's because they all want certainty as well as individuals. They want certainty of profits and cash flow going into the future. So they don't want people swapping away from them if they can help it. Whilst we're on the topic of banks, I noticed that Lloyds Bank this week have declared that they intend to buy up 50,000 houses as they want to become a major landlord in the UK. Now, this is an incredible piece of news because Lloyds is a bank and therefore totally against taking any risk. But of course, a bank has realised, just like we do as individuals, that properties are pretty certain bets and much less risky than most other investments that you could be involved with. But Lloyds are doing something quite interesting because they're actually snapping up properties from under sort of individuals' noses. So I read about one development of new build houses of about 500 houses, I think. Lloyds actually went in and bought nearly 400 of them. So they're buying off plan, they're buying developments, they're buying properties and taking them away from normal residential purchasers. Now that can only have one impact, and that's to drive property prices up because if they're taking away a fair chunk of the supply and demand is constant, then prices will rise. But what a fascinating move by a bank. Again, it just shows that they want certainty going into the future. Now, I read something this week about being paid to go to work. Now, I don't mean getting your wages or your salary or your pay packet, but actually being paid to turn up. And Amazon are now paying a £50 a week bonus for if you turn up on time 100% of the time. Now, obviously, they exclude COVID and sickness from that calculation. But if you turn up on time, you get a £50 bonus per week. Now, that's extraordinary. I thought it was expected that you turned up on time, but apparently not. Apparently, you can be paid extra for being on time for work. And this comes shortly after Amazon have also paid a 1,000 joining bonus to new warehouse workers. And it just goes to show how the employment model is changing. The strength and the power is no longer with the employers, it's with the employees. So employers have to be flexible, they have to be more friendly, they may have to be more accommodating, because in all honesty, employees will just leave and go somewhere else where they get a better deal or a better bonus. So it's interesting how the employment, the workplace is changing following the pandemic, and it's all power to the people. Hope you've enjoyed those messages, and I'll see you again next week.